In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about how Elon Musk and Mukesh Ambani are now at war with each other with respect to internet spectrums. In the second story, I'll talk about why oil prices are rising and what it means for us as investors. And in the third story, I'll talk about inflation and we'll take a deeper look at why it has been rising as of late. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that is one level deeper and more comprehensive as compared to traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 17th of October. Let's begin with the first story. Recently, India made a very important decision regarding how it will allocate satellite spectrum, which is a specific kind of radio wave which satellites use in order to provide internet services to people like you and me. The government announced that instead of auctioning the spectrum, which is where companies bid in order to buy rights, it will allocate it administratively. Now, this means the government will decide which companies get to use it without any competitive bidding process in place. Now, I know this may sound a little technical to you, but this is a decision which affects billions of dollars in future investments in India, and it has triggered a rivalry between two business giants, Mukesh Ambani and Elon Musk. Let me explain what exactly is happening. Look, India is currently in the process of expanding its digital infrastructure, particularly in those areas where traditional cable-based internet like fiber optic networks is very hard to build. Satellite internet is seen as the next best solution for reaching rural and remote regions. It can bring the internet to those places where laying down physical cables is not feasible. Now, as this new market develops, companies are competing to be the ones who deliver internet services through space-based satellites. Elon Musk's company Starlink is one of the major players in satellite internet today. It has launched thousands of satellites into low Earth orbit, and they provide satellite internet services in many countries across the world. In India, Musk wants Starlink to be a part of this new wave of internet connectivity. On the other side though, Mukesh Ambani through Reliance Jio is also very keen to be involved in satellite broadband. Mr. Ambani and Reliance are pushing for a spectrum auction where they feel they stand a better chance. So then the question becomes, how should the government allocate the spectrum that is needed for satellite services? Should it follow the traditional route of auctioning it, or should it be allocated directly to the government without any competitive bidding? Now, this is what the two parties, Elon Musk and Ambani, are fighting upon. Now, you're probably wondering what is the difference between these two options. Let me break things down and simplify it a little further. Look, in an auction, companies would bid for spectrum licenses which could raise billions in revenues for the government. This is how India has traditionally allocated mobile network spectrum like 4G or 5G services. Mukesh Ambani supports this route, and he's arguing that it creates a level playing field. An auction would ensure that only companies who are willing to pay high prices like Reliance Jio could enter the market, which maintains fairness in competition. But on the other hand, administrative allocation means that the government simply decides which companies get to use the spectrum based on factors like the service that they plan to provide and how fast they can roll things out. Elon Musk's Starlink advocates this particular method. He argues that auctioning this spectrum is unprecedented globally for satellite broadband services. According to Musk, spectrum for satellite use is shared, unlike mobile networks that require a dedicated band of spectrum. And auctioning the spectrum would raise costs for companies like Starlink, which would make satellite internet more expensive and less accessible, especially for underserved communities. Now, a couple of days back on 15th of October, India's Telecom Minister Jyotiraditya Scindia confirmed that the country would allocate satellite spectrum administratively. This decision is now in line with international practices where most countries allocate spectrum for satellites without holding any auctions. The government's stance here is that auctioning satellite spectrum would put India at odds with global standards. Reliance Jio, in response to this, has sent letters to the Telecom Minister and the TRAI, or the Telecom Regulatory Authority of India, and they are arguing that this decision was made prematurely without consulting the entire industry. Jio feels that administrative allocation will favor global companies like Starlink and Amazon's Project Kuiper. Reliance's main argument is that these foreign players will have an unfair advantage as they will not have to go through the expensive auction process which Indian telecom companies have faced for mobile networks in the past. Now, the reason why this battle seems to be so intense today is because satellite broadband market in India is expected to grow at about 36% annually. Revenues here could touch about $2 billion by 2030, and this makes it quite big a market for anyone wanting to enter into. For Elon Musk, this decision is very crucial because Starlink wants to very quickly deploy its satellite internet services in India, and an administrative allocation would allow them to do so at lower costs. Mukesh Ambani, on the other hand, though, sees this decision as very challenging to Jio's dominance in the Indian telecom market. With its massive user base, Reliance Jio sees satellite internet as a potential disruptor in the future because it can help expand internet services in areas that currently have no or low internet connectivity. But all that said and done, this very disruption could take a lot more time in India than what it may sound like. Starlink, which is already operational in other countries across the world, has a much higher ARPU or average revenue per user as compared to Indian telecom services. Starlink's ARPU is around 1.5 lakh Indian rupees, while Reliance Jio's ARPU for comparison is just 195 rupees. Yes, you could say that this is apples to oranges as a comparison because the technology is different, but in a market like India where affordability drives mass disruption, this price gap is way too large to even consider. Now, apart from this, technology limitations add another layer of complexity. Satellite broadband requires the use of special equipment like satellite phones because they operate on a higher frequency as compared to traditional mobile networks. This means that for the average person to access satellite internet, they would need to buy a satellite phone or a compatible mobile device, which makes things even more expensive going forward. So, all said and done, mass disruption through satellite broadband in India may not quite happen as quickly as previous technologies like 3G and 4G, which had a cost advantage to themselves. Even though Elon Musk's Starlink could very quickly roll out services under the administrative allocation, the cost of using these services, both in terms of subscription fee as well as equipment, might limit its reach to a very specific niche, at least initially. But regardless, if two giants like Elon Musk and Mukesh Ambani decide to pick up a battle, you know for sure that things are not going to stop where they are now. There are bound to be constant developments here, and I will be sure to keep covering them in the future episodes. Now let's move on to the second story, which is about the oil market. See, the oil market is in the middle of a bit of a storm right now, and that storm has a lot to do with rising tensions in the Middle East, changes in oil production, and forecasts about how much oil we'll actually need in the future. Let me break things down in very simple words for you so that even if you're new to this, you will understand how everything fits together. First, let's understand what exactly is happening in the Middle East. See, on the 1st of October, Iran launched a big missile and drone attack on Israel. This was not an isolated event, it was a retaliation for earlier Israeli strikes that had targeted and killed some very senior leaders of groups like Hamas and Hezbollah. For your context, Hamas and Hezbollah are organizations which are known for their strong anti-Israel positions. In very simple terms, Iran and Israel have been in a bit of a shadow war for many years now, and this very attack marked a major escalation in this war. Why does this matter to the oil market, you might be wondering? Look, the Middle East is home to one of the most crucial pathways for oil to the rest of the world, the Strait of Hormuz. This narrow strip of water is squeezed between Oman and Iran, and it connects the Persian Gulf to the Arabian Sea. Now, the reason why this is important is because around 21% of the world's oil passes through this strait every single day. That's about 21 million barrels of oil, which makes it the largest oil transit route on the planet. A huge chunk of oil that flows through the Strait of Hormuz heads to countries like China, India, Japan, and South Korea. These four countries alone account for more than 2/3 of all the oil that passes through this location. Now imagine if the conflict escalated further and Iran tried to block this crucial passage. What would happen? Even if other routes were used, they would not be able to replace the sheer volume of oil which passes through the Strait of Hormuz. Global oil supplies would face massive disruption and prices would likely shoot up massively. For now, there is some relief though. Israel has reportedly told the US that it will not retaliate by hitting Iran's nuclear or oil production sites in the near future. Instead, they will focus on military targets. Now, this is important once again because any strike on Iran's oil infrastructure could throw the global oil market into quite a bit of chaos. With that said, let's now talk about OPEC, which is the Organization of the Petroleum Exporting Countries. and how they are trying to manage this particular situation. Look, OPEC, very simply put, is a group of countries that produce a large chunk of the world's oil, and they team up to decide how much oil to produce in order to influence prices. Together with its allies, which is known as OPEC Plus, they have been carefully adjusting oil production in order to keep prices stable. Right now, OPEC Plus has cut oil production by 5.8 million barrels per day, which is a way to support prices by reducing supply. Now, one key thing that OPEC has is spare production capacity. This buffer is very important because if a conflict suddenly disrupts supply, OPEC could pump more oil into the market in order to help balance things out. According to the US Energy Information Administration, or EIA, OPEC has around 4.5 million barrels per day in spare capacity in late 2024, and the majority is held by Saudi Arabia and the UAE. The International Energy Agency, or the IEA, estimated this number to be slightly higher though. They estimate that there is a capacity of 5 million barrels per day. But there is also a downside to having the spare capacity. See, once OPEC uses the spare capacity, the buffer against future disruptions is reduced quite a bit, and this could make the market more volatile in the future. So OPEC is always in a bit of a tricky spot. They have to decide how much to release without depleting their reserves. But all of that said and done, what does the future of oil really look like? Look, the answer is not at all straightforward. Forecasts from experts are all over the place. Major banks and energy agencies do not fully agree on what is coming next, mainly because there are so many moving parts out here. But let me take you through some of these predictions very quickly. JP Morgan thinks that the price of Brent crude oil, which is one of the major benchmarks for oil prices, will average at $80 per barrel in the fourth quarter of 2024. But they expect it to drop into the low $60 by the end of 2025. Goldman Sachs has a more cautious approach here. They say that if supply disrupts, especially from Iran, Brent prices could jump to $90 per barrel in the short term. In the worst case scenario, they see prices reaching the mid $90 by 2025. The International Energy Agency, or the IEA, is a little more bearish here. They think that the demand for oil will not quite grow as fast as it used to grow in the past. They forecast that global oil demand will only increase by 900,000 barrels per day in 2024 and about 1 million barrels per day in 2025. This is a big slowdown as compared to the 2 million barrels per day growth we saw in 2023. Now, on the flip side, OPEC is more optimistic about demand. Even though they have lowered their forecast a little bit, they still predict demand to grow by 1.93 million barrels per day in 2024 and 1.64 million barrels per day in 2025. The difference in these forecasts come from a mix of factors like how fast economies are growing, how quickly the world is transitioning to renewable energy, and the rise of electric vehicles like we discussed in yesterday's episode. The IEA has pointed out that the sale of electric vehicles, especially in China, is surging, and that is starting to cut into oil demand for transportation. In China, 60% of car sales are now electric vehicles, which is absolutely massive. Despite these pressures on demand, geopolitical risks like the Middle East tensions are keeping oil prices on the edge right now. In fact, oil prices have jumped in October due to the escalating conflict between Iran and Israel. Brent crude futures were trading at around $78 per barrel, which was up $8 from the previous month. But in the absence of a major conflict, the IEA believes that we might actually have too much oil on hand as we move into 2025. They have pointed out to over 1.2 billion barrels in public stocks, with another 500 million barrels held under industry obligations. Now, this surplus could put downward pressure on prices unless there is a big disruption. So to sum it all up, the oil market is being pulled in different directions right now. On one hand, geopolitical tensions in the Middle East could lead to some supply disruptions which could push prices higher. On the other hand, slowing demand growth, which especially as electric vehicles become more popular, is putting downward pressure on the market. The OPEC is trying to balance these forces by managing production and keeping some spare capacity in the reserve. But the market's future will heavily depend on whether or not conflicts escalate and how quickly the world continues to move away from oil. It's a complicated scenario for sure, but one thing is very clear. In the near future, both investors as well as consumers will need to keep an eye on developments in the Middle East, the global shift towards clean energy, and how oil producers like OPEC respond to these changes are very important to track. Now let's move on to the final story of the day and talk about something that is affecting pretty much everyone, whether or not you have noticed it, which is inflation. See, in September, inflation in India spiked sharply to 5.5% as compared to 3.7% in the month of August. Now, that might sound like a couple of percentage points only, but that is a huge jump in economic terms. When inflation rises quickly, it means that the cost of living for everyday people goes up faster than usual. So the question then is, what is behind this sudden increase and why does it matter? Let me break it down for you in very, very simple terms. For starters, it is absolutely normal for inflation to happen gradually, but the problem actually happens when it jumps sharply, like from 3.7 to 5.5% in 1 month, which we have just seen. This then catches the attention of economists and policymakers because it means people's everyday expenses start increasing very, very quickly, and that can make life harder, especially for those people who are already struggling in order to make ends meet. A big reason for this rise in inflation is food. Food inflation jumped to 8.4% in the month of September as compared to 5.3% in the month of August. This is a very, very steep rise, and when you look at it closely, vegetables are the biggest culprit here. Vegetable prices surged by a massive 36% in the month of September, which is the highest increase in 14 months. So if you have been to the market recently, you may have noticed that these basic ingredients have become much more expensive as of late. But it's not even about just vegetables. Fruits have also seen a jump in prices. Inflation for fruits has hit 7.6% in the month of September, which is up from 6.5% in the month of August. Then there's also edible oils, which is things like cooking oils we use in our daily cooking. After 19 months of falling prices, these prices have flipped and now are going up again. Inflation there is at 2.5%. Now, all of this shift matters a lot because edible oil prices are influenced by both what happens in India as well as what happens around the world, especially since India imports a lot of its cooking oil. But that said, food prices is just one part of the picture. We also need to look at something called the core inflation. Now, this, for your context, is inflation without food and fuel prices included because these tend to be a little more volatile in comparison. Core inflation gives us a sense of the overall price pressures in the economy. In September, core inflation also went up to 3.5%, which is the highest it has been in the last 9 months. One area driving this rise is personal care products, which is things like soaps, shampoos, and other everyday items. In September 2024, personal care inflation rose to 9%, which was a noticeable increase from 8% in the month of August. But all of that said and done, the biggest question here is, why are prices, especially of food and vegetables, increasing so much? It's a mix of multiple factors. Let me explain. First is uneven monsoons. See, India's monsoon season plays a big role in farming, and this very year, while the overall rainfall was 8% above normal, it was not quite distributed evenly. Key farming regions like Punjab, Haryana, and parts of UP and West Bengal did not get enough rain when they needed it. This affected crop yields, which means there is less food to go around, which pushes prices up. The second reason is extended monsoon and pre-harvest rains. See, monsoon season also lasted longer than expected this year, and some pre-harvest rains have also ended up damaging crops. This is particularly concerning for the kharif crop, which includes pulses like lentils and oilseeds. When crops are damaged, it reduces the amount that farmers can sell, which again drives prices up. The third reason is global factors. See, India, like I said earlier, imports a lot of its edible oil, and global prices have been rising here. The global price rise, which is combined with local factors, is pushing edible oil prices higher in India. Also, geopolitical tensions like what is happening in the Middle East right now can create a lot of uncertainty in global markets and could eventually affect commodity prices, including food. Next is supply chain disruptions. See, this is not always talked about in detail. See, ongoing issues in global and domestic supply chains can also contribute to price increases. If there are delays or bottlenecks, the cost of transporting and storing food goes up, and these costs can be passed on to consumers at the end of the day. So with that out of the way, the biggest question then to ask is, with inflation spiking, what does this mean for the RBI and the country? See, the RBI is responsible for keeping inflation in check, and it does this mainly by adjusting interest rates. Higher inflation makes it very tricky for RBI because raising interest rates can help control inflation, but it can also slow down economic growth. For now, though, most experts believe that the RBI will be cautious here. They probably will not lower interest rates until the first half of 2025 unless there is a major economic slowdown before that time. The good news, though, is that there might be some sigh of relief here. The Kharif harvest, which is the crops sown during the monsoon season, will very soon start entering the markets by the end of this very month. If the harvest is good, it could ease food prices quite a bit. But again, it is hard to say for sure because unpredictable weather and global factors could still keep prices very high. Analysts from financial institutions like Kotak Bank and Bank of Baroda expect inflation to average between 4.5% and 5% for the fiscal year 2025. So while we may see some relief, inflation is not likely to drop drastically anytime soon. Let's now move to the final section of the day, which is the news tidbits. First, SEBI has raised the position limits for trading members in index futures and options to 7,500 crores or 15% of open interest OI, whichever is higher, from the previous 500 crore rupees. Now, this applies to both client and proprietary trades. The new limits will take immediate effect with updated monitoring mechanisms starting from April 2025. Second, India has signed a $4 billion deal with the US in order to acquire 31 Predator drones, enhancing its defense capabilities across the Navy, Air Force, and Army. The deal, including a maintenance facility, strengthens India-US defense ties and positions India for more modern drone warfare. Third, Bluestone Jewelry plans a $250 million IPO in mid-2025, which follows a recent funding round that doubled its valuation to about $970 million US. The company is competing with brands like Melora and is capitalizing on the growing organized jewelry market in India. Fourth, Adani Group is investing $3 billion to enter the semiconductor manufacturing space with a larger $7 to $8 billion commitment by 2027. This venture aims to reduce India's dependency on imports and serve sectors like defense, AI, and automotive. That's all the news and stories I have for you today. I hope you found this episode valuable. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.